topic that I've seen a lot of discussion around in the last couple of weeks is how your Roth conversion strategy should or shouldn't change if the current tax cuts are extended beyond 2025. I've seen some say that Roth conversions are no longer needed. Others believe that your overall strategy shouldn't change one bit. Now, this is going to be a little bit less technical of a video, but I want to give you some high-level thoughts on how we see things here at Safeguard. With the latest election, we saw a Republican trifecta, where the right have control of the presidency, Senate, and House. Any way you slice it, this will have some big implications when we talk about income taxes. During the first Trump administration, a law was passed called the Tax Cuts and Jobs Act. As you can see with the breakdown on the right-hand side of the screen, the tax cuts lowered taxes almost across the board. The kicker with this tax act was that it was set to expire at the end of 2025. Given that we are in lower tax brackets than we are expected to see in the future, Roth conversions right now as a tax-saving strategy were given some extra juice. But now that we are entering the second Trump administration with a Republican majority, the probability of these tax cuts reverting back to the old brackets has dropped precipitously. The question on a lot of retirees' minds is, if we see the current tax rates extended indefinitely, how does this change my Roth conversion and tax strategy? Are Roth conversions even still valid? That's what I want to give some insight on in today's video. Now, before getting into answering this question, we all need to get on the same page in understanding how to judge if a Roth conversion is even beneficial in the first place. A Roth conversion is a strategy where you decide to pay taxes on a portion of traditional IRA money right now, convert it to Roth in order to never be taxed again. Given this and how tax math works between tax-deferred accounts and Roth accounts, judging the value of a Roth conversion comes down to the tax rates you pay today versus the tax rates you would otherwise avoid in the future. If you pay a lower tax rate right now than you would otherwise see in the future, that Roth conversion is tax beneficial. Said another way and shown with a mathematical proof on the screen, if you paid 22% in taxes on a conversion today to avoid that money otherwise being withdrawn from an IRA in the future at 22%, you have an equivalent scenario. If you pay 22% today to avoid 25% in the future, voila, you have a beneficial Roth conversion. This is hard for some people to wrap their heads around for two reasons. One, some feel that there should be a negative tax consequence from a Roth conversion because money is leaving your pocket today due to taxes and you have less compounding for you in the future. Others feel that a Roth conversion should always be better because once you do that conversion, now all future growth within that account is compounding tax-free. Although I understand how someone can get to both of these ideas, as you can see on the screen, neither of these ideas are valid. But given this Roth conversion logic, we can see that these potential tax changes can have a big effect. If taxes are expected to rise in the future, this gives current Roth conversions a little bit extra juice. So what should you do with your Roth conversion strategy right now? High level, let me give you 5 takeaways that might help out. If we see the Tax Cuts and Jobs Act extended indefinitely, keep in mind that only one case for Roth conversions has been eliminated. Many retirees, as they dig into their numbers, will still find that Roth conversions are beneficial to some degree. For instance, if you have a big tax-deferred account and because of this, you have large required minimum distributions that are expected to be forced to you in your 70s, again, that situation won't change. Those RMDs could push you up into higher brackets and that still leads to a reason to convert today. Tax brackets aren't rising in this case, but your tax liability or your tax rates are. If your income in the future pushes you into different penalty zones, like Medicare's IRMA that causes you to owe a little bit more for Medicare costs, again, that will be a tax hike in a sort. Or if your income pushes you into different tax traps that will raise your marginal tax rate, like the Social Security tax torpedo or the widow trap, where you go from married filing jointly brackets to single filer brackets. All of these are still completely valid reasons for Roth conversions. Sure, taxes going up makes Roth conversions more obvious on the surface, but if you dig into the nitty-gritty details of your situation, Roth conversions are still likely completely valid, but the exact strategy you implement could vary. Let me try to walk you through a more micro example of what I mean here. Let's say we have a retiree who is 65 this year and delaying Social Security to 70. Most retirees will find Roth converting before Social Security starts to be most beneficial. Now, why is this the case? Because once you're on Social Security, your tax brackets really transform. For instance, before Social Security, this retiree will be taxed at the normal income brackets of 10%, 12%, 22, 24, and so on. But as soon as they file for Social Security, we expect this individual's tax bracket to look something like this. In blue, you will see the regular normal tax brackets of 10%, 12%, and 22%. On top of this, however, you see a purple zone that shows the add-on tax this retiree will have as their Social Security benefit becomes taxable. Here's how you read this graph. In the background, this person's $40,000 Social Security benefit is already being considered. So if they pulled $10,000 from their IRAs, you'd find this point on the graph. Now, they would still be under the standard deduction here and therefore would pull that $10,000 tax-free. If they pulled $30,000, the first 13 or so thousand dollars would be taxed at 0%. The next portion would be taxed at 15 and 18.5%. Then the last $10,000 would be taxed at 22.2%. Knowing this retiree is facing down this tax graph, we still see a lot of opportunities for Roth conversions if this retiree had some sizable IRA assets. Say we expect future RMDs to be $40,000 plus in value. Those withdrawals are going to push this retiree into the most costly parts of this tax trap. So using the Roth conversion logic that we showed earlier, does it make sense for this retiree to convert at 10%, 12%, and 22% to avoid RMDs in the future? Of course, because they will be paying lower rates now and thus see tax benefits in the future. They may even find that considering a 24% conversion might be beneficial, but certainly the 10, 12, and 22% conversions I think are obvious here. If the Tax Cuts and Jobs Act did in fact retire and we saw higher rates, the main thing that changes here is those conversions become even more obvious. I'd make a case the 24% conversion becomes more obvious there. Number two, if the Tax Cuts and Jobs Act is extended indefinitely, the next takeaway is that you will see more aggressive Roth conversion strategies start to make a lot less sense. For instance, if we just focus on general brackets, you can see some tax rate games that can be played here. Let's say you forecast that in retirement, the top tax bracket you'll be subject to is the 25% bracket, what is currently the 22%. Well, converting right now at 22 and 24% is less than 25%. So a lot of retirees right now can see a clear benefit of actually converting up into the next bracket right now, and they would still see tax savings in the future solely because of the tax tables expected to rise. If current tax rates stay the same, this type of aggressive converting really no longer makes sense on the surface. Why convert at 24% to save at 22%? There still might be reasons, again, when we dive into those detailed tax traps, but obviously that takes a lot more work, knowledge, and software solutions to dive into that complexity. Takeaway number three, if we see Roth conversion aggressiveness drop, it will take longer, more drawn out Roth conversion strategies to fix your tax problems. This is kind of obvious if you think about it. If we believe the tax cuts were going to expire, we might be maxing out the 24% bracket for a period of time, then dropping down to the 22% bracket, what will turn into the 25% bracket. If the tax cuts are extended, math might adjust where maxing out the 22% bracket consistently might make the most sense now. Given this, we'd be forced to do smaller conversions, and more importantly, smaller conversions earlier in retirement. Between these two scenarios, over $200,000 less would be converted for this example couple situation. That $200,000 will continue to compound inside of a traditional IRA, meaning the situation on the right will need to convert for a longer period of time because ultimately they're converting less each year. So again, it's not as if Roth conversions would no longer be valid, but the strategy may adjust. Takeaway number four, you will likely see the overall tax savings from a Roth conversion strategy go down if we see the current tax cuts extended. Again, this should be obvious if we think about it. If taxes rise in the future, the benefit of a conversion today obviously goes up. If taxes go down in the future, so does the value of that conversion. On the screen, I have a tax chart for a 65-year-old couple with a bit more than $2 million in assets, about $1.7 million of which is tax-deferred money. This chart shows the top marginal bracket this couple would be expected to experience each year in retirement. Maxing out the 22% bracket in this situation would be expected to deliver about $500,000 of value to their situation. If the Tax Cuts and Jobs Act is extended indefinitely, the same strategy still makes sense, but now sees about $70,000 less of overall after-tax benefit. Then finally, takeaway number five, don't put too much emphasis on the specific tax policy and if it will be extended or sunset. I know that's crazy to say given the data I've shown thus far, but hear me out. It would be hard to permanently extend the Tax Cuts and Jobs Act. When tax reforms are proposed, a majority is needed in the House, but in the Senate, due to filibuster provisions, 60 votes are needed in favor of that law. They didn't reach 60 votes before, and based on the current makeup of the Senate, to permanently extend these tax cuts, all 53 Republicans would need to vote in favor, plus 7 Democrats. If 60 votes aren't reached, the other option is called reconciliation, which essentially means a temporary tax reform can be put in place as long as it can be proven to be a deficit neutral plan over 10 years. In this case, only a majority in the Senate is needed. So this is what happened in 2017 and why the tax cuts were temporary and not permanent. it's very likely to be a reason a permanent extension fails this go around as well. So rather than a permanent extension, we could just be looking at another extension on the sunsetting. Say the sunset date is extended for another 8 years. Well, every takeaway I discuss in this video might be a moot point for your situation. You might still expect to see higher taxes down the road during those crucial RMD years. In this case, you actually see a big benefit from the extension because now you get additional years of lower tax conversions. Even beyond this, regardless of what happens with the Tax Cuts and Jobs Act, administrations only last for 4 years. We could see a shift in Congress in just 2 years. 4 years from now, we could see a completely different presidency with a completely different tax code proposal. We are still going to be facing big debts that need to be dealt with here in America at some point. Now, I don't want to get into some prediction game because then we can really make any decision make sense by just changing the assumptions, the variables, and more. I just want to bring both of these up because I want you to avoid being a rubber band decision maker. I've seen some retirees, huge fans of Roth conversions, wanting to convert all of their IRA assets during the Biden administration. And then Trump is elected and they go to the other extreme, thinking conversions aren't needed anymore. This type of extreme back and forth based on minor changes and variables isn't helpful. The truth is, yes, your Roth conversion strategy will need to dynamically update as we gain more information each and every year. This is a constant. It's always the case. But most changes in your portfolio, tax strategy, or any other part of your retirement should be small, consistent adjustments rather than massive one-time adjustments. I hope this video helped shed some light on the future of Roth conversions. If you're someone wanting to learn a little bit more about what a Trump presidency might mean for your retirement taxes as a whole, click this video right here. Thanks for watching, and always remember, you don't need more money, you need a better plan. I look forward to seeing you in the next video.